Rohr here with an early, concise highlight on Monday, June 30th, 2014. And it's going to be concise today because we have seen the foreign exchange move in the direction we suspected, but not really change that much from Friday morning's global view that include all the markets recover. So we'll be looking at the equities and the fixed income this morning and mentioning what's up in the foreign exchange. And the first thing we would also note on the macro side is that the data was kind of mixed from overseas into the big end-of-month data release. Japanese industrial production and a couple of different sets of housing figures were pretty weak, but surprisingly, small business confidence was strong. German retail sales year-on-year were up more than expected, but on a weak note coming out of the Eurozone, something that may not be that bad for the equities because it will continue to stimulate thoughts of further stimulus from the European Central Bank, is a kind of a soft Eurozone consumer price index reading. Now today, of course, and again at the top of a very huge week, starting Tuesday, of all your global PMIs. You have, of course, whatever other data is coming out. You have Thursday morning's ECB meeting and press conference into about the same time as the early release, in deference to the U.S. 4th of July closure Friday, of U.S. employment. But for today, we've got the Milwaukee and Chicago purchasing managers indices, pending home sales, and ultimately then at the end, the Dallas Fed Manufacturing Index. So looking at the short-term view of the S&P 500 index, what we saw was this downside reversal last Tuesday morning after setting the new high for the rally in the contract up at 1959.80, which actually was just a hair above the lead contract high set previous week, actually, by the June contract before the reaction and before it expired up at 1959.50. The market reversed back down from the close at 1953. That leaves a tolerance up here at the 1955.5 level. Now, that has worked as key resistance on rallies, market only getting back up to the low 1950s so far, and this morning it is off $2 right back at 1950 even. So we would suspect, unless it can get through 53 to 55, it can take some pressure again. And of course the lower support remains down initially into the overrun objective that was also the upside acceleration going back to the FOMC response, going back to a week ago Wednesday on the 18th, above 1938. And that has some immediate residual support into 1935, which we were looking for before the market even dipped off last Tuesday or on the sharply lower activity early Wednesday. If it should break that, there is further support down around 1920, but the big support remains down into the 1900 area, runaway gap to the upside, the one that set up the 1938 objective. And on the upside, the oscillator and topping line on the longer term charts point toward 1965 to 1971 as the key resistances above the market. And that pretty much does it for the short-term view of the S&P 500 future. Moving over to the intermediate term, what we have is the direct manifestation of, the topping line. As you can see this week, it's going to be up around 1971. And just rounding and calling this roughly 1830 or so, even though it's 1831, 135 points over on the oscillator is where we're getting our 1865 area, obviously to maybe a little better than that. And you can see here how that same Fibonacci 25% retracement we were looking at on the short-term chart turns up on the daily chart, and there was also a fairly aggressive upward channel that comes in the low 20s today and works its way up to higher levels throughout the week. But here's your bigger support. This was the daily runaway gap down just below 1900, 1897, and here's the weekly version, pardon me, into the low of 1904 when the market gapped higher coming in after Memorial Day weekend.